Do you remember when the price of gasoline broke above $3? Or $4? Or like here, near Seattle, even $5? What were you thinking when that happened? If you're like me, you probably thought, wow, I better drive less and save my gas until prices come down. Or maybe you thought, there's no way prices can go any higher. It's already way too high. Whenever a large group of people notice that a product's price has moved above a certain value and they stop buying it as a result, they're creating something called a resistance zone, a level where prices can no longer easily move higher. Similarly, whenever a group of people notices that a product's price has moved below a certain value and they buy more of it as a result, they're creating a support level, a level where increased demand helps support prices and prevents them from going much lower. Hi, I'm Sarah at Stock Charts. In today's video, we're going to explore how to spot resistance and support levels on a chart, how to profit from them, and how they're related to trend lines. And we'll also explore how to use the volume by price tool to help identify support and resistance levels. Let's get started. So, how does a resistance zone form? Just like you and me, traders have memories when it comes to prices. They're also very aware of what they've paid for the stock and whether the stock has gone up or down since they bought it. They're also aware of the recent price behavior of that stock. By looking at a chart on the stock's price, they know if the stock is making new highs, new lows, or is reaching an important level where it has changed direction in the past. Remember, a stock's price represents the consensus of the buyers, the bulls, and the sellers, the bears, about the value of the stock at that specific point in time. If there are more buyers than sellers, the price will move higher since demand for that is outpacing supply. If there are more sellers than buyers, the price will retreat to a lower level. A stock that is consistently moving higher is said to be in an uptrend. A stock that's consistently moving lower is said to be in a downtrend, and a stock that's consistently moving sideways is neither up or down and said to be trendless. Now imagine that a stock is in an uptrend. The number of buyers is larger than the number of sellers, and the prices are moving higher as a result. But each time the price moves higher, both the buyers and the sellers reevaluate their options about that stock. In particular, the buyers may compare the stock's current price to its previous price in the past. If they see, for instance, that the stock is approaching its all-time high, buyers may decide that it's gone up high enough, and they may return to sellers at that point. If enough buyers turn into sellers at that price point, then the price will start to fall, and then an uptrend will eventually turn into a new downtrend. The price level where things change is said to be a resistance level for that stock. Anytime prices return to that level, there's a pretty good chance they'll reverse again and head lower. In addition to buyers feeling that the stock has gone up enough, another reason that a resistance zone forms is that a lot of traders have bought the stock in the past around that level, only to watch in dismay as the stock has moved lower soon afterward. We've all been there, right? You finally bought a stock that you've had your eye on because you're convinced it's going to go higher. And what happens? Yep, it starts heading down. So frustrating. Now, what happens in that situation? Suddenly, you start hoping and praying that that stock somehow moves back up to the level where you bought it. You tell yourself, if you ever get back to break even, I'll gladly sell it and never look back. And so, when it does return to that level where you bought it, you and probably many others will sell, causing the stock to start moving lower again, and further cementing that as a resistance level in the minds of other traders. What about support levels? How do they form? A support level forms in the exact same way, only with the opinions of the buyers and sellers reversed. Buyers who don't buy when the stock started moving higher immediately regret not buying it and tell themselves, if that stock ever returns to a lower level again, I'm going to buy it. And then when they do, that lower level becomes a support level. How can you spot a support level or resistance level on a chart? There are two common ways to spot support and resistance levels on that chart, either by using horizontal annotation lines or by using the volume by price overlay. At StockCharts.com, when looking at the chart, you can always click on Annotate and then select the horizontal line tool to start searching for support and resistance levels. Simply use your mouse to move the line up and down on the chart until you find a place where prices appear to reverse and bounce off the line in the opposite direction. Remember, The more times the prices have reversed at that particular level, the stronger that level is, and the more likely that price will bounce off of it again in the future. The other approach for finding support and resistance levels is to add the volume by price overlay on your chart. This overlay is a series of horizontal histogram bars that stick out from the left side of your chart, and the bars show you the total amount of volume that has occurred on each price level on that chart. For example, on this daily chart, whenever the prices close between 120 and 123, the volume for that day is added to the horizontal bar at that level. Since there are lots of days with heavy volume where prices closed within that range, that bar is actually taller than the other bars. To spot possible support or resistance zones, look at that level where the volume by histogram bars are significantly longer than elsewhere. That's a good indication that there's a significant support or resistance at that level. So how can you profit from support or resistance levels? The trick to profiting from a support or resistance level is to find a level that's been historically strong in the past and that the stock is about to test again. Again, no trading strategy is foolproof, but you can find a stock that is heading towards a strong support or resistance zone. And if you do that, the odds are ever in your favor. Simply buy or sell that stock at that level in the expectation that it will reverse again. Of course, you'll also need to set some protective stops, and you'll need to watch the stock closely to make sure it behaves exactly how you expect. And here's an advanced tip. Use the slow stochastics indicator to confirm that the stock is reversing in the zone as expected before placing your trade. How are support and resistance zones related to trend lines? A trend line occurs when a stock's price is consistently moving up or down over a period of time. For an uptrend, a straight trend line is drawn below the price bars to show where the prices are expected to reverse and continue increasing after a short pullback. Notice that, in this case, an upward slanting trend line works exactly like the horizontal line does for a support zone. In both cases, prices are expected to bounce off these lines and move higher. That means an uptrend is simply an upward slanted support zone. This also means that in an uptrend, the number of buyers is increasing relative to the number of sellers. That increasing number of probably impatient buyers is what slants the support zone and turns it into an uptrend. In a downtrend, everything is just reversed. So the number of sellers is increasing relative to the number of buyers. What can you use to spot trends? Unfortunately, you can't use the volume by price indicator to spot trends. It only works for horizontal support and resistance levels. But there is a different tool that you can use for spotting trends, the ADX indicator. The ADX indicator is a thick black line that moves up and down over time. You can add it to a stock charts chart just like you would any other technical indicator. The black ADX line shows you whether a stock is trending or trendless. Whenever the ADX line is moving higher, the stock's current trend, either upward or downward, is strengthening. As you can see from this example, as the ADX indicator moves upward, so does the price, indicating a strong upward trend. Shortly after, the ADX indicator moves upward again, demonstrating another strong trend. But this time, the trend is moving downward. When the ADX line is high relative to its normal levels, the stock's current trend is considered to be very strong and will probably continue. When the ADX line is close to zero, the stock is considered to be trendless and will probably continue moving sideways. Today we've covered resistance and support levels and their relationship with trend lines, but let's take a moment to outline some key takeaways. We saw how resistance levels are like price ceilings and are formed when a large group of people notices that a product's price has moved above a certain value that they're willing to spend. We saw how support levels are the inverse of resistance levels, acting like a price floor. These are formed when there is an increase in demand, which typically ensures prices won't move much lower. We also saw real examples on how horizontal annotation lines or volume by price overlays can help you identify resistance or support levels. Additional examples showed us how support and resistance levels can turn a profit, especially when those levels have been historically strong in the past. Trend lines have a close relationship with support and resistance levels and can help you anticipate the stock's next move. Lastly, we saw how the ADX indicator helps spot trends. When it's going up, the trend is strengthening, and when it's going down, the trend is weakening. If you liked this video, be sure to subscribe and ring that bell. I'm Sarah at Stock Charts. See you next time.